Hello, everyone. Today, we are going to delve into one of the most practical topics in finance, and that is stock valuation. Whether you want to become an analyst, an investor, or simply you want to manage your own portfolio, you will need to answer one key question. What is a stock, and what really is it worth? And that's exactly what we're going to look at in the next um, 40 minutes or so. So by the end of this session, you should be able to understand the value of preferred stock as a perpetuity. You need to understand the value of common stock using the zero growth model, the constant growth model, which we call the Gordon's model, the non-constant model, and also be able to calculate the yield. Ideally, it is also important that I invite you into being a potential stockholder. Besides just learning, we are advised to invest in stock. So we're going to look at what is called um, stock. Preferred stock. What is preferred stock? So preferred stock is a type of stock that promises but not guaranteed. It usually promises to pay a fixed dividend at the board's discretion. So this kind of stock has preference over the common stock for dividends and assets. The formula is as given. The value of stock is the dividend paid over the cost of preferred stock, KP. That is our formula that we're going to use. So now, this is the value of preferred stock. Now, notice something that there is no growth term here. Why? Because preferred stock dividends are typically fixed. It's actually a perpetuity. So as you know from our time value of money lessons, perpetuity is simply what? Cash flow dividend. It's simply the cash flow divided by the discount rate. So from our example here, we have 8%, $100 par value, and the required return is 10%. So we want to calculate the value of preferred stock. So what do we do? Our dividend paid is 8 because we calculate 8% times 100. That's the one we put on top there. Then our 10% we divide it, that's 0.10. So we're going to get 80. Therefore, even though the par value is $100, an investor would pay $80 today given 10% required return. So now we go into a transition into what is called common stock. Common stock. This is the actual stock. What is common stock? It represents the residual ownership in a corporation. It is usually valued on pro rata basis. So dividends may be paid out using what is called pro rata. So when we say residual ownership, it means that you are the last in the line after the creditors, after the preferred shareholders are paid. So why would you now want to buy common stock? Because of two potential cash flows. You have what is called the dividends. If they're declared, you also have what are called the capital gains, where you're selling at a higher price. And this is where the valuation gets interesting because dividends can grow. Dividends can stay flat. Dividends can grow over time. So we're going to look at the dividend valuation model, which is a core idea of this lesson that we are having now. The valuation model. So I've talked about what most stock orders are. So now let's look at the dividend valuation model. So simply a model that accounts for all future valuations. So the dividend valuation model, the value of common stock is actually the present value of all the future dividends. So in theory, what we are talking about in practice is that we are forecasting for infinite dividends, which is impossible. So we need to make assumptions about the patterns of these dividends. So we have three patterns we're going to look at. There's what is called the zero growth, the constant growth, and the non-constant. The constant growth has a constant growth rate, and the non-constant has a high growth rate, and later on, um, it's stable. It goes in a stable mode. So we're going to start with the simplest, which is called the zero growth model. Zero growth model. So the zero growth model, um, so we have constant growth model and zero growth model. So the zero growth model is one that has no growth rate. The formula is the same, the one we had with preferred stock. So the value of the zero growth model is simply D1 um, K minus G. So now let me teach you something about dividends. You can use the future value formulas. Remember, future value is equal to present value 1 plus growth. Now, the zero growth model, the formula is simply the value of stock is called D1 over KE. So it's a perpetuity, it's given like that. So if you're given the dividend now at 3.24, the growth rate is zero, the cost of equity is 15%. So just divide 3.24 over 0.15, so the 21.6. This is what we call a zero growth um, model. So now you need to understand that the dividend in year one, based on the dividend in year zero, is simply D0, 1 plus G. D0 means the dividend declared in year zero. The power is the difference between the years 0 and 1. So here there will be 1, which is invisible. So these 2 is equal to D0, 1 plus growth. But what is the power we're going to have there? It's power 2. Why is the 2 coming in? The difference between the years that we are talking about here. 2 minus 0, that is 2. Okay, how about D3 based on D0? Can somebody try? This will be D0, 1 plus growth. The power what?
3.
Power 3. So sometimes the growth rate may be the same in the first 3 years. Maybe it changes in the fourth year. So D4, you cannot start from D0 because now you're continuing from the previous, at least you can continue from the previous year. If you're going to put D3 here, what becomes our power? The power what? 1, because the difference between the two is 1. If this was constant growth, you can even use the same formula to get the answer. If it was D4 on D2, the difference is in the years. So this is what you need to know. So now, suppose we have our initial dividend as 10 kwacha and our growth rate is 8%. Can you forecast the dividends for year 1, 2, and 3? I'll teach you a simple method. So the dividend is equal to what? 0, 1, 2, and 3. So D0, we are starting with our growth rate of how much? 10. So how do we get the growth rate for D1? It's D0, 1 plus what? Growth. And what is our D0? The power 1. What is our D0? 10. 10 times the growth rate is 8%, so this 1.08 to the power 1. So here we're going to have 10.8. Now mathematically, you can be multiplying the subsequent years here times 1.08 to get, this is 8%, the easiest way. Just multiply by 1.08 to get the next answer. If there was 12%, you'd have been multiplying by 1.12. The 12% here, 1.08. That is the quickest way to projecting the next dividend. Or can use the same long formula that I gave you. It's still the same answer that you'll be getting. So be cognizant with some mathematical tools that you learned in your grade 12. So if it was 20%, you'd have multiplied that by 1.20. So the normal way here to get D2 is what? D0, 1 plus growth, the power 2. So ordinarily, we're going to say 10 plus 1.08 to the power 2. What do we get? 10, 1.08 to the power 2. What do we get? 'Others just multiply this 10.8 times 1.08. You still get the same answer here. Okay.
11.664.
Yes, 11.66. Okay. So it's what you're going to get either way. Then this answer to go to the next year, you just multiply times 1.08. That's the quickest way. You're going to get what? 12.60. So this is what we call a constant growth. It's growing constantly. If you were using this formula, then D3 is going to D01 plus go to the power 3, just to project the future. All right. Then suppose they tell you that for the first 3 years, you're growing at 8%. Then years after 3 years, you're dropping from 8% to maybe 5%. Okay. And the market rate is KD is 15%. So tell me what would be the growth um, in year 4? What would be the dividend in year 4? What are we going to multiply this 12.60? Are we going to continue with 1.08 or we're going to adjust the growth rate? We multiply by 1.05. Why are we multiplying by 1.05? Because the growth for the first 3 years, year 1 to year 3, is one that is 8%. That's why we're using 1.08 here, 1.08 here, 1.08. But going to year 4 onwards, the growth rate has dropped to 5%. So now I'm applying 5%. So 1.05 there. Are we together? So meaning our figure for year 4 will be 13.23. So this is how we can project the various growths. Now, we want to know the value of stock today. So we need to discount these ones using what we call the Gordon's model. I'll get to that later on. But for now, I just needed you to have this foresight of having to calculate our growth using the constant growth model, the dividend model. Okay? So now, looking at this formula here, we have what we call the constant growth model or Gordon's model. So Gordon's model asserts that or assumes that dividends will grow forever. The value of stock is simply D1 K minus G, assuming the growth rate is less than the market rate. So why must the KE be greater than G? It should always be greater than growth, otherwise the denominator will be negative. And that will imply that we have infinitely or negative value, which doesn't make sense. So our value of stock using the Gordon's model is V is equal to D1 K minus G. Now we know that D1 is what? Is the same as D0, 1 plus growth. So you need to understand the Gordon's model. So how do we then apply this if you're given an example? So V is equal to D1 K minus G. So the K, like I've said, should be greater than our growth rate. So you can manipulate this also as value of stock now is equal to what? D1 we know is the same as D0, 1 plus growth over what? K minus G. So if we are told that D0 is 3.24, the growth is 8%, the KE is 15%, how do we calculate the value of stock? So value of stock is D0, which is what? 3.24. 1 plus growth, our growth is 8%, so 1.08 over K minus G, our K is 15%, so 0.15 minus the 8%, which is 0. What? 0.08. So when you calculate this, you calculate the value of stock to be $50. So see the difference here is that our value doubles to more than half from the initial 21 under the constant growth to this one here, the $50. So tell me, if we had our dividend 1 as 10 kwacha and we had our growth as 8%, and we have our market rate as 18%, how do we calculate the value of stock using Gordon? What's the formula? Elisa, how do we calculate the value of stock, common stock? Grace, are we moving together? We are just calculating the values of stock using just 3 models. The first one was the constant growth model, which simply says D0 or D1 is equal to what? D0, 1 plus growth. We are basing this on the dividend we have now. And now we are just using the Gordon's model to calculate the value of stock today, common stock. Value of common stock is simply what? V0, value of stock now is equal to what? D1 K minus G. What is our K? Our K is, our D1 is 10, our K is 18%, 0.18, and our growth is 8%, 0.08. So when you divide these two, we're going to get our value of stock as 100 kwacha. So this is how we calculate the value of stock using Gordon's model. Let me try again. Suppose we gave you our D0 as 10 kwacha. Our growth rate is 5%, and our market rate is 12%. Which formula do we use now to find the value of stock now?
Do we first calculate for D1, or do we use the formula that has D1 equals to D0, 1 open brackets 1 plus G?
Yes, so if we calculate our D1, we start with D0, 1 plus growth. And what is our D0 in this case? 10.
10,
And what is our growth rate?
5%, 0.05.
So we're going to have 1.05, right? So this is our D1, therefore, will be 10.5. So now using Gordon's model, how do we calculate our value of stock now? D1 over K minus G, right?
Yeah.
So the value of stock, therefore, will be what? 10.5 over our K is what? 12, 0.12. And our G is what? 5%, 0.05. So that's 7%. So 10.5 over 0.07, what do we get? 10.5 over 0.07, we get 150. So this is the value of stock now. All right. So there's nothing really complicated here. I'm just taking step by step, understanding how the valuation of these stocks can be. So when you hear in a word form to say just declared or just received the dividend, just know that is D0. So stock, common stock or constant growth has experienced dividend growth of 8%. So here our G is what? 8%. Each share has just received an annual dividend of 3.24, and the appropriate discount rate is 15%. What's the value of stock? So what are we given in here? Our growth, G, which is 8%, our D0, which is what? 3.24, and our K, which is 15%. So you first find your D1, which is D0, 1 plus growth. Here we had 3.50. Then the value of stock is G, D1 over K minus G. So our D1 is 3.50, then 15 minus 8%. So we get 50 as our value of common stock. Is that clear? Clary, are we together? Okay. Now, the zero growth rate, I already talked about it. It is simply the formula that we use in perpetuity. It is D1 over K. So if stock zero growth has a zero growth rate and just received 3.24, and the appropriate discount rate is 15%, that's the value of common stock. So we say just divide the value of common stock 0.24 over 15%, we're getting 21.60. So you see the difference. This one is not growing at all as much. All right. Now where our calculation becomes interesting is when you have multiple growths. So this is now where our lesson begins. So we'll look at this example here. All right. So can somebody identify what is happening there? A company has its required rate of return 16%. So this is our K. And the growth rate is 30% G1 for the first 3 years. So our G1 is 30%. And then drops to a constant rate of 10% G2. So our growth in the second phase is 10% G2. And the most recently paid dividend, D0, is 1.82. Find the value of common stock. So these are multiple phases. So here, what is our D0? 1.82. Then it is growing to year 1, year 2, year 3, and year 4. For the first 3 years, the growth rate is how much? 16%, 30%. So we multiply each of these years times what? 1.3, yes? Remember the shortcut I gave you. You're multiplying each of these years times what? Times 1.3, because it's growing by 30%. 1.3 for the first 3 years. 1.30 and 1.30 also here. But wait a minute, before it goes to year 4, it drops to what percentage? 10%. So what are we going to multiply to go to year 4? Melissa, what are we going to multiply to go to year 4? Since it dropped to 10%?
Sorry, 1.1?
Yes, 1.10. If it dropped to 4%, 1.04. So this is the easiest way of projecting the next growth. So our initial was what? 1.82. So we're going to multiply 1.82 times 1.30. So here we're going to have 2.366. Again, the answer times 1.3, here it will take us to 3.0756. And then we multiply our answer again times 1.3, we get 3.99. Now from here to a 3 to a 4, we're going to multiply times 1.10. We're going to get what? 4.39. So now, ideally, it's better to put them in two decimal places, just want to avoid over rounding off. So this is the projection of the growth of the dividends in year 1, year 2, year 3, year 4. Now, to calculate the value of stock now, for the first 3 years, we're just going to discount them. So this was just helping us to calculate a starting point. But it's not important now. So we want to calculate the value of stock in year 1 to now, in year 2 to now, in year 3 to now. Okay, so phase 1, we'll calculate the value of stock and we total them up. So just getting the present values. So here is 2.366 and our market rate is 15% or 16%. So we're going to divide this by 16% so that we get the discount rates. So when divide by 16% here, it should be 1.16 to the power 1. When you discount this one, divide by 1 plus R, 1.16 to the power 2. You discount this, the present value, remember topic 1, 1.16 to the power 3. Want to find the value of stock now. So let's discount these two and add them up. So 2.3 2.366 divided by 1.16, you will get 2.04. That's the present value for year 1 when discounted. Okay. Then here, 3.0758 divided by 1.16 squared, you get 2.29. Then here we discount this one, 3.999 divided by 1.16 power 3, we get 2.56. Okay, then we add them, 2.04 plus 2.29 plus 2.56. Here you get 6.89. 6.89 is the value of stock for the first phase, year 1 to year 3. All right. So this is how we calculate the value of stock in phase 1. Now you said 10% thereafter. So this is second phase, phase 2. So it's going from this thereafter. Now remember, using whenever you hear thereafter, using Gordon's model says the value of stock now is D1 over K minus G. Now, our D1 for this second phase is the same 4.39 because it's like we're starting now afresh. So meaning year 0 for this phase is in year 3. So we want to calculate the value of stock as at year 3 here. So what is the value of stock as at year 3? Is D1. Our D1 is what? 4.396. Then our K, which is our market rate, 16%, and our growth rate for the second phase was what? 10%. So 0.10. So the value of stock as at year 3 will be 4.396 divided by 6% here. So meaning the value of stock as at year 3 here will be how much? 73.266. But we want to find the value of stock now also here. So we also take it back to year 0. So how do we take it back to year 0? By discounting it using the market rate. So when we take it back from here to this side here, we're also dividing, since it's on year 3 here, we're going to divide it also by 16% as of year 3. So 1.16 to the power 3. So here, we are going to divide this answer, 1.16 to the power 3. So here, this value for phase 2 will be 46.93 or 94. Okay. So now the total value of stock now, you add the two. 6.89 plus what? 46.94. So the value of stock has 6.89. So the total value of stock will be 53.83. So this is how we calculate the value of stock for multiple phases. So it's tedious, it carries more marks, but again, it's worth it when you follow just what I've talked about. So you have two models there. There's a constant, and there's what? The there's constant, and there's also the Gordon's model. So the final answer we're going to get therefore is 53.86 or 87. All right. Let me go through it again. We have the model that we've been given. This stock is growing. The first phase at 30% for 3 years, and the second phase at 10% thereafter. And the market return or required rate of return is 16%. And the company just declared 1.82. So we need to value the value of stock now. So this is what we call a multi-stage phase. So the first one is you calculate the dividends for year 1, year 2, year 3 for the first 3 years here. So remember, you can use the constant growth model to illustrate that. So D1 is equal to D01 plus growth to the power time. So D1, using the way I taught you, you're using D0. So these ones here, you're going to multiply. So year 1 will be 2.366, 3.076, 3.999. So these are the dividends for each of these 3 years here. Okay? But again, we want to discount them to now by dividing the market rate, which is 16%. All right, you can use a table or 60 divided by 1.16 to the power 1 divided by 1.16 to the power 2, 1.16 to the power 3. So to give you the present values of these dividends. For year 1, year 2, year 3, it will give you 6.88. Remember, we calculated that. Although I love the number line because it helps you see what is happening. So this 6.88 is what we calculated after discounting these figures here. So what did we do in relation to the way I did it? I produced the dividends for year 1, year 2, year 3, then discounted them 1.16 to the power 1, 2, and 3. So when I took them there, these are the discounted values here I have. So we have 6.89. So this is the dividend for the first phase. Is that clear? So this is how we got here for phase 1, the total. Then we went to phase 2 to find the present value as at year 3. So we have to find dividend in year 4, K minus G. So the dividend in year 4 was what? 3.99 K minus G. So we needed to multiply this 3.99 times 1.10 because it was helping us calculate the value for D4. But from here, this is 3.99. To go to D4, we just multiply times 1.10 to go into here. So this is how we found the 4.39 to start with. So this is what we are going to call our D1. So 4.39 is how they calculated this one here to get to 4.39. Okay, the top part here. Then divided by what? K minus G, 16% minus 10%, that's a 6% here. So this gave us 73.32. But this is the value of stock as at year 3. So in this year 3, we found 73.26. So we discount this one again because it's in the third year backwards. So that 73 can be broken down and taken to the present value now as what? 46.96. Then you add those two, the first phase and the second phase. So when you add them, you calculate the value of stock today in the market. I hope that is clear now. Are we together? Any questions? Melissa?
No questions, thank you.
All right. So now your homework will be to calculate the value of stock for this particular stock. Okay? Your homework will be this one here. So you need to follow exactly what I did. And I'll need my work before the end of the day today. Is that clear?
Clear, noted.
All right. So mm, our next topic will be cost of capital. So these follow each other. Those that missed bond valuation, please watch the video for bond valuation. I'll send it through. I know we have newcomers, but don't worry. These topics are independent, but cost of capital is dependent on that. So before cost of capital, I think I'll need to meet the newcomers to take them through um, bond valuation.